And we generally strive to not only provide financing, but also technical assistance and training to our small business borrowers. So welcome to all of you. Thanks again for joining us. I am going to go ahead and mute everybody just so that we cut back on the background noise. If you have to talk to us, you can use the chat and question boxes on the bottom. Okay, there we go. Sorry about that. See, you jinxed me, Holly. Not the technical on top of everything today. Well, so our webinar today is on financial statements, and like we just kind of alluded to, I mean, they're sort of like thermometers for you, how your business is doing. Is it viable, sustainable, profitable? What are your biggest revenue streams? What are your biggest expenses? But we as small business lenders know that small business owners sometimes get really overwhelmed with keeping track of everything, and it might seem easier sometimes to just leave your accountant or bookkeeper to deal with it all and kind of not worry, as long as there's enough money in your bank account to cover everything. So we're glad that you're here today to join us, because we'll really try and walk you through kind of baby steps to really explain to you how these different statements work with each other, how they can help you to manage and grow your business. So we'll hope that you really find that useful. As in all the previous sessions, Holly is going to do the presentation. Thanks and welcome, Holly. Holly speaks at a lot of small business workshops, forums, on a variety of business topics, and she serves on several advisory committees and boards relating to financial literacy and supporting small business owners in their efforts to develop and expand their businesses. So we're really happy and glad to have her, and we promise she's going to walk you through it really slowly, and we'll try and make it even a little fun if we can. I kind of just walked everybody through, I think, the technology, but just to kind of do a once-over for the people that have just joined us now. I hope everybody can hear me. If there are any issues, you can use the question boxes on the bottom and send in your questions to us. We can interrupt the presentation at any point in time to address those questions. We will also, at the end of the presentation, take everybody off of mute, just so we can have an actual discussion and talk to people to see if there's any other questions that we can just chat with in person for a little bit. I think that's kind of the basics. We won't have any polls today just because the information we have is kind of already pretty dense, and we're hoping to get through everything in about an hour. So we don't want to keep you away from your business any longer than we have to. And with that, I think we'll go ahead.
Okay, great. Thanks, Simone. Thanks. Simone sort of said this, but I have been watching some commencement speeches in the last couple of weeks as various colleges are graduating students, and I saw one that I thought I definitely want to share with you, and it was a commencement speech that Charlie Denson, who's the president of Nike, made, and the quote that I wanted to share with you is to always strive to know more in order to make it better. And I really think that's the main purpose of today's webinar with regard to understanding financial statements, that they're a tool. I'm not expecting, Simone and I are not expecting you to walk away with a thorough understanding, but we're hoping that you walk away realizing that this is a tool and it's your business, and knowing a little bit about financial statements and over time learning more and more will help you manage your business better. So first of all, what is accounting other than something that everyone dreads? Accounting is a language of business, and I love that definition because it really is the way we organize all of the financial transactions within your business. Accounting is how you keep score in your business. As a small business owner, you really can't wait until the end of the month or the end of the quarter or the end of the year sometimes to find out how your business is doing, so that if you go out and hire a professional accountant to do your books and your tax return, which I certainly am supporting that you do, you still can't wait until the end of the month, the end of the week, the end of the end of the month, the end of the quarter, the end of the year to know. There are certain things you have to watch all the time. For example, your cash, and we're going to talk about that in a little bit. You also need to watch your expenses. It would be horrible to find out that at the end of a quarter you've been spending an enormous amount on something that you could have gotten cheaper. And knowing your financial statements and knowing what they're showing will help you ask those questions along the way. Accounting is also, the formal definition is recording, classifying, and summarizing of financial events that take place in a business or an organization. Accountants like things in order, and that's what accounting does for you, the small business owner. It sort of puts everything in order in a way that you can understand it. So why is accounting important? Well, you're going to hear me use the word you a lot, and I say it with emphasis because it helps you, the business owner, make informed decisions. It keeps track of where your money is in your business, where it's coming from, what your revenue streams are, where it's going to. It communicates how your business is doing so that you can share it with interested parties, people like banks, other vendors, people like us. It gives you a way of communicating how your business is doing. Without accounting, you're really shooting at a target in the dark. It's sort of like heading to a destination without knowing how to get there. Even if someone else, and I can't emphasize this enough, even if someone else is keeping your books, you need to understand what your financial situation is because you really call the shots about your business. I'm going to share with you that Simone and I have had over some period of time, both of us have had situations where we know of people who have hired bookkeepers or somebody to do their business, and unfortunately the person's not doing things right. So you need to know enough so that you ask the right questions. You need to be able to identify whether or not your business is making money, are your products or your services priced accurately, and cash flow coming in and going out. What is it today? What is it this past week? What is it the month ahead? Cash is something that you have to watch. It's not something that you have an abundance of in a small business, at least at this point. I expect you all to have big businesses before too long, and we're rooting for that. But when you're first starting out, cash is scarce, and you need to watch it. Just another thought. Are you doing well enough to expand, or do you need to cut back? Can you hire more people? Do you need to trim down on staff or on inventory? I recently had a conversation with someone who we were discussing building inventory, and I said, the last thing you want to do is be inventory rich and cash poor because you need to have that correct balance as well. Okay, now the general ledger. I really don't want you to bail out on me now, but general ledgers are really not so bad, and I just wanted to bring it up as a term that you probably hear your accountants say or you hear other people say. It's really not something that should intimidate you. Its purpose is to organize accounting transactions just so that they can be found and understood. It's as I have here in the presentation. It's really a play-by-play of every transaction that occurs in your business. So when you write a check, there's something that goes into your general ledger. When someone sends you a check, there's something that goes in the general ledger. When you buy something, either inventory or pay for something like rent, it goes into your general ledger. So the general ledger is the repository of all financial transactions in your business. And it's from the general ledger that financial statements are created. So those of you who use QuickBooks, you're really making transactions into something called a general ledger. And then when you hit the button and produce a balance sheet or an income statement or a cash flow statement, you're actually using information that's in the general ledger to produce those documents. Most businesses, even very small businesses, use an automated financial software package to keep track of their general ledger. I really encourage all of you to do something like that. While we're always willing to help you, and I'm sure your accountants will do the same thing, I think they're cheap enough. I mean, QuickBooks now is under $200 and very easy. Just knowing the audience that I know is out there now on this webinar, you all have some sense of how to use technology, and QuickBooks is by far, for small business, is the one that most accounting people recommend. And they don't even pay me to say that. I have no interest in doing that. All right, so let's just go through the three statements that we're going to talk about. We're going to talk about a balance sheet, we're going to talk about an income statement, and we're going to talk about a cash flow statement. Really, all of these statements are what I like to call their scorecards. The balance sheet itself gives you a snapshot of your business at a specific point in time. That's different than the other two statements that we're going to talk about. But a balance sheet just shows you the stuff that you have, which are your assets, and the stuff and what you owe on that stuff, who owns it, and what you owe. So you have assets, and you have liabilities and owner's equity. And owner's equity is generally what the owners own of the assets after all the liabilities are paid off. There are different categories on a balance sheet, and I just wanted to run through them really quickly. There's current assets, and that's cash or other assets that can be converted into cash within 1 year. There's fixed assets, which are property and equipment owned by the business, and fixed assets could have a life that's longer than a year. And you have long-term assets, receivables that might not be due to you, that might not be due this year, but might be longer than that. Sorry, just let me catch up here. Okay, liabilities. Liabilities are when you owe someone, you're liable. I just wanted to give you sort of a way of remembering. When you owe someone something, you're liable to that person, and liabilities are what your business owes to someone or to another company or a bank or a person. Owner's equity, this is a part of the company's assets that you, as in the owner, owns. And it's really calculated as assets less your liabilities equals your owner's equity. And technically, again, over an overview is if you closed your business today, this is the amount you'd be able to walk away with in assets, meaning cash or equipment. I made a very, very quick, simple balance sheet that I just wanted to have you take a look at. Yonkers Yogurt. I love yogurt. I like the fact that we had 2 Y's. That's why in the title. That's why I named it that. But assets are the stuff you have. So your current assets, like we just talked about, would be an example of that is cash. Your fixed assets, a computer, it has a life longer than a year. And on the other side, liabilities and owner's equity, who owns it? A loan that's payable to a bank, and the equity and net income is what the difference is. Wonderful thing about a balance sheet, and all accountants will tell you that, is it's got to be balanced. Your assets have to equal your liabilities and equity. As a young accountant, there were many times when you'd hear a yes come from my cubicle when I was able to balance a balance sheet. Okay, the second scorecard is an income statement. And an income statement has a lot of different names, and I just wanted to, again, so that you know that they're all the same thing. An income statement can be called a profit and loss statement. Some people just, for short, say a P&L. It shows the income earned and the expenses that you've incurred. The difference between income and total expenses is what they call your net profit, or the bottom line. It shows you how much your business is making. Are you profitable or you're not profitable? And the difference, again, a balance sheet is at a snapshot at a point in time. An income statement is over a period of time. For example, like a 1-month period of time, or a 3-month period of time, or a 1-year period of time. So it's over a period of time. In its simplest form, an income statement is presented just in the following manner. And I have it in words, and I'm going to show it to you in a sample in a second. But income is whatever you're getting for the the products that you're selling or the service you're providing, minus or less the cost of sales, so that whatever it costs you to deliver that product, whether it's inventory that you have to purchase or shipping that you have to use in order to deliver the product. It's anything related to actually delivering that service. So, for example, and I'm going to digress just for 1 minute, if you're paying rent on a property, rent on a property is not how you deliver your service or your product. Inventory or supplies are. So you'd have that rent whether or not you were successful in selling your service or product. The rent would still be there. And we're going to talk a little bit more about a variable cost, which is the cost of sales. Those expenses would vary depending upon how much you were selling of your product or service, whereas rent doesn't vary at all. Rent is X dollars a month no matter what you're selling. All right, so let me just take it from the top here since I digressed. Income and receipts are what you get for your service, less the cost of sales. That equals, you hear people say gross margin or gross profit, and essentially they mean the same thing. Gross margin is presented in dollars, and gross profit is presented in dollars, and gross margin is a percentage. Just they are the same thing, but I think those are two terms that you should know, and those of you who have gone through our committee process know that those are the kinds of things that are asked by some of the committee members. It's a very important statistic for you to have. Less your fixed operating expenses, and that equals your net profit. Okay. An income statement begins with the dollars you earn from selling or doing something, and it can be called revenue, sales, income. Again, lots of different names for the same thing. Income, it can be called income. Net income is what you earn, but if you're talking about what it is that what you're getting for your sales, they can also use the word income. So again, just be prepared for lots of different terms for the same thing, and you might want to clarify with whomever you're talking to, making sure that it's what you understand it to be. It's important that you note that income or sales or money's earned, but not necessarily collected. So, for example, if you offer credit to a customer, you have actually earned the revenue at the time that you make the sale, but you may not have collected the cash yet. All right, cost of sales. After the sales for your business are displayed on the income statement, the next section is this cost of sales, and these costs are called variable expenses, what I described a couple of slides ago. These expenses vary depending upon the volume of the sales that you make. Variable expenses are the cost of doing business and might include direct labor, materials, shipping. They increase with sales since they're direct cost of delivering your product. The gross margin and gross profit, as I mentioned, gross margin is a percent, and gross profit is an actual number. And really, it is you take your sales, subtract out all these direct expenses, or your cost of sales. They mean the same thing. Subtract the two. The difference is your gross profit. And then if you take your gross profit and divide it by your sales, that's your gross margin, again, represented in a percentage. And gross profit is really a critical number for you to understand, because it's what you have left over after you've delivered your product to pay for all the expenses of your business, the rent and the utilities and salaries, if they're not part of the direct cost of your product. I hope I haven't lost anybody yet.
Nope, but they're all still there.
And they're all still there. Nobody's run.
They might just all be overwhelmed. Just one thing for me to clarify, so if somebody has a service business, though, they would account for their cost of goods sold as the time that they spend providing that specific service versus maybe the time they spend on actually running their business. Right? Is that right?
Mm-hmm.
Okay.
Yeah. Expenses. So following gross margin or gross profit, the next section of the income statement shows your expenses, not the expenses incurred to produce your product or to deliver your service. These expenses, again, are called fixed expenses. And I'm just sort of clarifying this again. I'm sorry. It seems like I'm saying it several times, but it's for purposes of emphasis. Salaries, rent, insurance, advertising, interest payments on a loan, these are expenses that would be there whether or not you had sales or not, and that's why they're called fixed expenses. Your net profit is the money that's left over after expenses are accounted for and subtracted from the sales of your business. So the net profit really shows how profitable your business is over a period of time, and it's really critical that you watch that. You don't want to find out at the end of the year that you've not been profitable or that you've been pricing your product or service incorrectly based on the cost of delivering it. That's why you want to watch it often. Just to sort of, again, maybe this is a digression a bit, but I wanted to throw it into the mix. Sometimes you have to invest in a large asset that has value over a longer period of time, and I just wanted to explain to you how those are handled in the scorecards. So let's say you're building a building or you're purchasing an expensive piece of equipment. That equipment or that building has a life that's over a longer period of time. So you wouldn't just put it into expense. What you would do is you would pay for it and set it up as an asset on your balance sheet. And then over time, as this asset ages, let's say you buy a piece of equipment and you're told by the manufacturer or by whomever you purchase the equipment from that it typically should last you about 6 years if you maintain it properly. Well, let's say you bought it for $600,000 just to make life easier, and they said it would last for 6 years. You would write $100,000 off of it. It would be written off over 6 years, so $100,000 each year would be shown in your income statement as depreciation. So some of you, it depends, and it's a judgment call, but something you should understand. Some of the equipment that you purchase, I'm not suggesting that if you buy a can opener that can last for the end of time, that you write that off over several years. But there's a level of materiality that you should consider, so that if you purchase something that has a longer period of time, don't be detrimental to your financial reports by showing the expense all in the current year, because it really has a benefit over 3 years. You're really using up that asset over 3 years, so you should be writing it off over a 3-year period. I think Simone mentioned that you can write any questions that you have in, but I'm hoping that I've made that clear enough, and you can ask questions if you need to later on. All right, an income statement, again, back to Yonkers Yogurt, just to make it clear. So we're showing sales and the cost of sales, which I don't know what it takes to make yogurt, but I'm sure there's a lot of good things in there. And then the gross profit, and just to sort of, I should have done it myself earlier, but if you took the gross profit of $2,000 and divided it by $5,000, it would show that your gross margin is 40%, but your gross profit is $2,000. Okay, just wanted to make sure you get that. And then your expenses are salaries and rent, total expenses, and then your net profit is this $1,400. So again, just a pictorial of an income statement. And it's for a period of time. In this particular case, it's for a 3-month period, October, November, and December. So again, a balance sheet would be a balance sheet as of December 31st or as of June 30th. an income statement shows the activity of your business over a period of time. Okay, before we move on to the last scorecard, which is a cash flow statement, I just, again, wanted to, I guess it's what I just said, I jumped in front of myself, but the balance sheet, which was the first scorecard that we talked about, shows your business's financial condition at a point in time. And the income statement shows it over a period of time. Okay.
Still no questions. I guess we're good.
No questions?
Nope.
Anyone snoring? Can you hear that?
Maybe I should unmute everybody.
I'm kidding. I'm kidding. Okay, so the next one is the cash flow statement, and it's the last one. Again, these are three statements that I really encourage you to get to know. The cash flow statement is scorecard number 3, and if you don't offer credit to your customers or pay your suppliers on credit, then cash flow is really easy. You start with the cash that you have on hand in the bank, and cash comes in from customers, cash goes out to pay supplies and expenses, and then you have an ending cash balance. And it's really, really an important document, especially for small business owners, because you don't have an abundance of cash, and you've got to watch it moving into your business and moving out of your business. Okay. So the basic rules, the cash flow statement should never have a negative ending cash balance. If you have a negative ending cash balance, it means you're bankrupt. Now, on the same token, I've had conversations with small business owners who don't keep track of their income statement, and when I ask them, if you're not watching your income statement, how do you know you're making money? They say, well, because I have cash in the bank, and that's just not a true statement. You need to. They're separate. They have some relationship, but you could have cash in your bank account, but still not be making money on your business. And you could also be making more if you understood your income statement and was watching where your expenses were going. Again, cash flow statement is really critical in managing a small business. I think I'm going to repeat myself, but let me just read this through you. Many businesses that file for bankruptcy protection are profitable on their income statement, but because they couldn't collect their sales, the inverse of what I just told you, through the accounts receivable that they had actually offered credit to their customers, or because they didn't plan for their cash needs, they find themselves without cash, and if you don't have cash, you can't run your business. There are really only a few sources of cash inflows, and let's kind of go through them because they're really easy. Cash that's collected from selling your product or service, cash that's collected from your customers who owe you. If you provide them with product and they say they're going to pay you in 30 days, you've earned that income, but they owe you on your accounts receivable. So typically a 30-day period. So cash from collecting on those accounts receivable, cash from loans that you get from banks or from others to help your business start to grow, and you know you're going to have to pay that back, and cash that you or others have invested in your business. Sources of cash outflows, paying expenses necessary to run your business, buying equipment or large assets. Remember we talked about that earlier. Buying inventory or supplies, making payments on liabilities, aka loans for your business, or liabilities meaning you bought something on credit, so your accounts payable, and distributing earnings to either owners of the business or dividends if you have investors. The ending cash balance on the cash flow statement equals the cash balance in your bank account. Again, one of the things that I find joyous about accounting is that you can always prove that you're right in certain of these statements. so you know that a cash flow statement should equal what you have in your bank account. And QuickBooks does a really good job of that, by the way. So the ending cash balance is calculated simply by what your beginning cash balance was at the period of time that you're evaluating. Whatever cash has come into your business, whatever cash has gone out of your business, equals the ending cash balance, very much like reconciling your checking account. There are lots of different formats that can be used, and I don't know if we're going to look at an example of one in a second, but use one that works for you. And what I encourage you most is to make sure that you're watching your cash on a daily basis, because I think it's important, particularly once as your businesses pick up. So again, Yonkers Yogurt, beginning cash balance, $1,600. They had sales, you might remember, of $5,000. They received a loan, it was a fictitious loan, of $4,000. So they had cash coming into the business of $9,000 during the course of this period. And I say for the period ending December 31st. This could be for a year, it could be for a month, it could be for 3 months, whatever the period is that you're evaluating. The cash going out, cost of sales, whatever it was that you needed to pay in order to make those sales. You might have purchased a computer, and if you remember, we did do that in a previous slide. And you might have paid various expenses for $600. So your ending cash balance should be $6,000. Again, I encourage you to perhaps go back over this presentation, and I'm also going to suggest a book to you as well, just to familiarize yourself with these 3 statements: the balance sheet, the income statement, and the cash flow statement. Those are the 3 scorecards that you need to have an understanding of. Okay, so let's review. Balance sheet shows a snapshot of your business at any particular point in time. Right now, we could run a balance sheet on your business, and it would be at this point in time. An income statement shows how your business is doing over a period of time. The cash flow statement shows the cash coming in and going out and what the net result is over a period of time. And again, it could be just one day, and I encourage you to watch the cash balances. All right, so before we get to questions, I did want to, and I just wanted to make sure that I suggested this, and I'll put it in an email to you after we're done. There's a really decent book that I think would be worth an investment, and it's called Financial Statements, a step-by-step guide to understanding and creating financial statements, and it's by someone called Thomas Idelson. And I think it's a pretty basic guide, and I want to emphasize that we were not expecting you to walk away with an in-depth knowledge of how to produce financial statements. I would consider it a real win if I've convinced you that you've got to be aware of these and that you can't leave it to someone else entirely. Again, I support you having an accounting professional doing your books, but I really need to emphasize again that it's your business. It's your business, and who cares more about your business than you? So you need to have enough of a knowledge that you can ask questions if there's something that you don't understand, and you have to not be afraid of these, because they really are the scorecards that will tell you how you're doing. So that was my objective. Simone, do you want to open it up to questions? Boy, we got through that really, really fast. I hope I wasn't going through through it too fast. And I'm a New Yorker. I just talk quick.
No, I think it was good. I'll unmute everybody in a second. I just do want to take this chance to kind of piggyback on what Holly just said and mention again to our existing loan clients, if you already have a loan with us, you should have received an email last week, the end of last week, from me, that we have some scholarships available still for you that you can use up until the end of June. It's $700 as long as you put in at least $100 of your own money. And a possible use for it would be if you want to have somebody come in and train you in QuickBooks, for example. I know that there's QuickBooks trainers out there, and I don't know how much they charge. But if you feel that that's something that would really be beneficial to your business and would help you to, get a better handle on your financials and grow the business ultimately, that's definitely something we can take a look at. So kind of just to keep that in the back of your mind. Or if you have any other uses, get in touch with us. We'll try and get that money out the door. So let me unmute everybody. Okay, hold on.
Is that claiming that people are unmuted?
Maybe we get back last everybody, like wherever we are. If you wanna kind of turn down the volume maybe on your computer.
Okay, I'm going to fax it right now. You're welcome. You're welcome.
Okay, then I think you can mute yourself. If there are any questions, go ahead. Anybody?
Hey guys, this is Nick. Thank you so much. Very helpful. Sorry, I'm here to go on. I got the question. I took the course to college, and the more I recording everything, the more I remember, kind of little bit by little bit. But we always thought about, getting a bookkeeper like you suggested. But we thought starting out would be good for us to really understand it in and out. So we're taking a stab at it ourselves. I think we're doing a pretty good job, but as we start growing, it's going to be a little more difficult. And in terms of bookkeeping, I wasn't sure if, we're not familiar with that part, like who to look for, if the accountant usually does that, or if we look for a standard bookkeeper, or what the process might be. Is it usually you meet with them every week or every month, or do you guys know anything on that side, or should I be talking to my accountant for that?
Well, I think if you've identified an accountant, they often have multiple different services, and we work with several accountants. But if you've got one, that's terrific, and I think you should have a conversation with them. And I have seen clients who meet with their accountant on a quarterly basis, and during the course of the of that, from one quarter to the next, they maintain QuickBooks on their own. You can do QuickBooks in many. Are you using QuickBooks, if I may ask?
We are, yeah, and
okay.
We find it very. I'm really in charge of the QuickBooks for now, and I'm finding it very manageable now. But as you know, we don't have too many people working with us just yet. So being pulled in so many directions, it's
right.
It would be comforting to have someone not look over the shoulder, but check on things from time to time. And I guess my accountant would really be helpful for that. But
yeah, I think you should have a dialogue with them. They offer various different services. Most accountants that I know, there are some who actually maintain QuickBooks for you.
Okay.
There are some that on a quarterly basis you just transfer it so that they can review it and make sure that you've got everything categorized appropriately. I would say, has your accountant actually looked at the way you've set up the chart of accounts?
Yeah, we're going through that with them right now.
Yeah, I think that's a great first step, because once they set up the infrastructure, I think maintaining it is a lot easier. Where we've seen some people go off down a bad sort of trail is because they don't know how to set it up.
Sure.
And I think it's worth the investment to get an accounting professional to set it up for you, and then as you're paying bills, I mean, QuickBooks now you can do checks from it, and you can do all sorts of things. Once you have it set up, then the maintenance of it is a lot easier. But it's the setup that takes the time. And frankly, everyone's got a different business, so you all have to identify the 3 or 5 or 7 different items in your financial statements that you need to focus on. You know, for example, you know, focus on cost of goods sold, and you want to watch on a trend basis, is that number climbing?
Sure.
You know, whatever the expense is, you know, I always encourage people, identify those ones that are important to whether or not you can, and it's an important conversation for you to have with your accountant. How do I tell that my business is making money? And figure out what those key items are on your financial statements that you should be monitoring. And the reason why you want to see the trends. You want to see, are you getting more efficient? Is your cost of goods sold as a % of your revenue going down because you're getting better pricing from your suppliers, or you know, or you're producing your product faster and more efficiently? So you want to watch the trends, and I think it's a very important dialogue for you to have with your accountant to you know, have them assist you in figuring out what those particular trends are that you should be monitoring all the time. You know, obviously you can't watch, you know, the office supplies on a regular basis, although, you know, I don't think it's a unimportant expense, but you know, you need to identify what's important to you and monitor them. So in answer, if I probably over-answered the question, but I think it's a dialogue that you have with your accountant. And remember, you know, your accountant is a service provider, just like you are in your businesses, and they aim to provide you, you know, it's their goal to provide you with the support that you need in running your business. So don't be afraid to ask questions, and you know, and have them be more business advisors than just merely crunching numbers for you.
Sure.
Business advisors is a role that they can and should play.
Sure. Yeah, I think that's great. I think the setup, you know, we never want to just hand it over to somebody. I think it's important to kind of keep the pulse of your business.
Absolutely.
Doing this day to day, but yeah, I think the initial setup is where, not that we're having trouble, but it would be nice to know that, you know, everything is done correctly, and from there, it's a lot easier to build off of that, like you said. So excellent. Yeah, thank you.
Right. And you know, just going back to, we talked about it a little bit in the presentation, you know, you may be buying a lot of things to start your business up. And in the process of buying all those things, if you're just looking if you're just recognizing all of those things in your financial statements as expense, you might be hurting yourself.
Yeah.
And not properly reflecting what your business is earning right now. So if you're buying equipment that's going to last, you know, over a period of time, your accountant can help you set that recording of it correctly, so that you're only recognizing a portion of it over, you know, in the current period, and not recognizing it all at once. And if you have someone looking at your business, and by the way, I mean, your accountant can you know, discuss this with you too. I mean, what they do for you on a tax basis can be different than what they do for you on an accrual basis, you know, which is more what you're going to keep your books on. So, you know, you can have that discussion with them as well.
Excellent. Yeah.
Okay?
Definitely. Thank you.
Okay, no problem.
Yeah, Holly.
Okay, we had somebody write in a question.
Holly.
Are there any other programs that I can use that is not QuickBooks?
Yeah, there are some, and of course my brain's not remembering them now, but I'd be curious to know, you know, what the opposition to QuickBooks is. But there are other products, and frankly, there are other products popping up all the time. The only reason I personally go back to QuickBooks is because, you know, it's been around for a long time, so all the bugs are out of it, and it's a tested product. But there are certainly other smaller ones or less robust ones that could be used. Again, there's multiple versions of QuickBooks, and they are pretty inexpensive. But Simone will keep track of who asked that question, and I'll give you some feedback on it.
Mm-hmm.
Yeah. Simone?
Yes.
Yes.
Also, how are you?
Good, how are you?
All right. Holly, one thing that I think should be added to this webinar is that you mentioned about people understanding their financial statement. But one thing that you did not mention is when they go back to talk to the accountant, they should be able to put on budget, because that way they will be able to know if the business is overspending or underspending, or where they need to focus more to have the business to go to the next level.
Very, very good point. Very, very good point, Uso. Uso's point is very valid. When many of you, those of you who are our loan clients, came to us, you gave us projections. You gave us cash flow projections, but tied into that was what you expected to earn. And a budget is very similar to that. You should be monitoring yourself against a budget all the time. Why are your expenses higher? Well, okay, my expenses are higher because my revenue is higher. I'm earning more. But you should establish a budget for your business. And again, QuickBooks has a vehicle to do that as well, where you put a budget in, and then you can do what they call a budget versus actual analysis, which provides you with a variance, so you can see where your expenses are higher than you anticipated, where your higher or lower than you anticipated, and it gives you a better feel. Particularly those of you that are startups, where you just don't know yet. You don't exactly know. You can get quotes from an insurance person, but you don't actually know yet what the cost of things are going to be. You might not have gone through a winter, so you don't know what the cost of what Con Ed is gonna be, or you've not gone through a summer, so you don't know what the cost of air conditioning is going to be. So there are some things that you'll know for sure. You have a lease, you have a rent payment, that you know for sure. But there are some expenses that are just estimates, and I hate to use that term, but it's a common term that could be used to describe the items that you'd have on your budget. They're estimates of what you think you'll spend and what you think you'll sell and what you think you'll earn. And it's very, very valid point, Uso, that you should be monitoring yourself against a budget. Okay.
Yep. We have one more question that's not directly related to the financial statements. What should I be looking for when I outsource for billing? So this is a service provider that's basically hiring an outside company to do their medical billing. I don't know that we have any specific expertise or
to do their
medical
billing.
Yes.
Meaning, is it a medical billing company?
No, it's a medical service provider that's going through a medical billing company to
pay for their health insurance.
No, to get payments on their clients, on their patients.
Oh, I'm sorry. I'm sorry.
Sorry.
I'm sorry. So in other words, the company provides a service for which they're reimbursed by an insurance company?
Insurance company, exactly.
Yeah. So what to look for in that?
Yeah.
Well, I don't have great expertise in that. I would suggest that you might want to speak to other providers of that sort of service. For example, I mean, we all have a doctor, and one thing that I think I'll say is, I am always inspired by the help that I can get from fellow professionals and associates and people in my network of people that we all know every day, and I would ask some of the medical professionals that you might visit what sort of things keep them up at night, what sort of providers they use. There are medical billing is now a profession, so I think that it's pretty common. So you might want to ask. I personally don't have any expertise in what's important. I would assume one very important thing is you got to be up to date on the regulations, because boy, you've got one dot in the wrong place and somehow you're not getting reimbursed. Because I think technology plays a huge role in that. In that these days as well. Sorry, I can't be of more help, but if you want to email me with the specifics, maybe we can reach out to our network and see if we can get you connected to somebody who could be able to help you.
Sounds good. And then we have one more question. If you could review the assets must equal liability plus equity. Mm-hmm. If you could just repeat that whole concept and how exactly that works.
Sure. You mind if I back you up? So I've got a balance sheet in front of us. Mm-hmm. And then there was also a question if we are sending out copies of the presentation. Yes, we'll send a copy to everybody afterwards, along with that Holly mentioned. Yeah, a copy of the presentation as well as a recording. So, okay, so here if we have a balance sheet in front of us. So the assets are $7,000. Can you see that? That's your current assets, which is cash, and the computer is $7,000. And the liabilities on the other side of the balance sheet, who you owes it, the loan payment to the bank, is $4,000. And the equity would be the amount that you, the business owner, has put into the business, plus what becomes part of your equity is what you have earned in your business, which is the $1,400. So take the $7,000 minus the liabilities, which is the $4,000, equals the $3,000 in equity. Is that clearer to whomever it was that asked that question?
We'll find out.
Sorry, not as interactive as.
Yeah, this is somebody that's on the computer, and I think there might not be a microphone installed, but
okay. All right. Okay. So well, they can always come back and email me, and I can pick up the phone and we can talk.
Okay, sounds good. And then we have one more question. I make custom hats, and I'm confused about the cost of sales. Obviously, that cost includes materials and the labor to make the hat, but what about research and shopping for those materials? Is that a direct cost as well?
Well, the answer to that is no, because the direct cost is what it is to actually make the hat. The research that you have to do is part of what I would consider like research and development. You would be doing that anyway, whether or not you actually made those direct sales, because it's part of what will define your business and define your product. So it is not part of the actual cost of making the hats. It's part of building your business and knowing what you're, building your product line. So it's not a direct cost. Cost of goods sold should be whatever expenses you incur to actually get that product, that one specific or that, those specific products out the door. And I personally, my view on that, as an accounting professional would be that research and development is not part of that.
Okay. That was pretty thorough, so let's hope that answered the question. Anybody else? Any comments, any questions?
I'd like to just make a comment, and I really mean this from the bottom of my heart. All of you will have, Simone has everyone's email address if I don't have everyone's, and I'm sure you'll get some communication from her. I'm going to give Simone the name of the book that I referenced, and also I'll be on the email. I really, really encourage you to pick up the phone or email me with any questions if I can be of any help. This is this is complicated stuff, and people go to school for 4 years to learn all this. But I think there is a way for it to have some clarity in your mind so that you understand it without, the extreme depth, but just so that you understand it enough so that it helps you manage your business. And I encourage you to reach out to me if I can answer any questions.
Sounds good.
Thank you guys so much. Really appreciate it.
All righty. Well, have a good day. I actually am sitting near a window, and I happen to see some sunshine. So I'm hoping you're all getting some sunshine in your day.
Yep. And just one more little request. If you get a follow-up email and a survey from us, we'd appreciate it if you could actually send in your comments just so we kind of can keep improving our services to you all.
Sure. Hey, Holly, Simone, is this presentation available?
Yes. We'll send it out.
Okay, thank you so much.